Welcome to the Market Mosaic, where every week we are taking a look at macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment. We're going to look at the intersection of all those variables to try to figure out where the market could be headed over the near term. And for this week, I want to start with the Federal Reserve. The Fed cut interest rates last week by a quarter point, and that was widely expected, but investors were caught off guard. They were caught by surprise on the outlook for additional rate cuts. And that is because Fed Chair Jerome Powell noted that another rate cut in December is not a foregone conclusion. You can see that there are deep divisions remaining within the Fed over the pace and magnitude of more easing from here. And a big part of that is because core consumer inflation is running at 3%. That is well above the Fed's 2% inflation target. You could even argue that the current level of the Fed funds rate is in neutral territory. And that is because when you look back, Fed funds has been around 100 basis points or 1% higher than consumer inflation on average. You can see if you were to plot that data, you would be able to extract that from this chart. This chart shows the Fed funds rate, which is the blue line, and consumer inflation, which is the green line on here. You can see, except for this period of really low inflation during the 2010s decade, overall you can see the blue line, for the most part, holding above the green line inflation throughout most of going back to at least 1980. And so if you were to average this out, you'd see on average the blue line is above the green line, Fed funds above inflation by about 1%. And that's where we are pretty much right now. So you could argue that Fed funds is in neutral territory. But here's the thing, at the same time that inflation is running above target, there is evidence that the economy is holding up fine. And the Fed's even acknowledging this. The Fed's, in their meeting statement, they added language noting that economic activity has been expanding at a moderate pace. And so that has investors repricing the outlook for additional rate cuts. Market implied odds for another cut at the Fed's last meeting in December stood at 92% before the Fed's most recent meeting. Following that meeting and Powell's comments, those odds are now down to 63%. But here's the thing, despite some of this growing uncertainty over the pace and magnitude of further rate cuts, tailwinds remain in place for this bull market. During their meeting, the Fed also announced that they would be ending quantitative tightening, also called QT. That's the process by which the Fed allowed government debt securities held on their balance sheet to mature without reinvesting the proceeds. And that's shrunk the Fed's balance sheet from a peak of $9 trillion in 2022 to $6.5 trillion now. And so that serves as a drain on the money supply. Now, ending QT removes that source of drain on financial market liquidity. But at the same time, so that's a boost, that's a good thing. At the same time, earnings season is showing a higher than average beat across both sales and earnings for companies in the S&P 500. And the S&P 500 is just now entering a favorable seasonal stretch, which is incredible to think because the index has already spent 125 consecutive days above its 50-day moving average. So this week I want to get into what earnings season says about the state of the economy as the government shutdown is dragging on, and we'll also look at the seasonality coming up for the S&P and some more implications for the Fed's most recent rate-setting meeting. All right, questions are swirling around the strength of the economy during the government shutdown. It's because the shutdown is limiting economic data releases, but don't forget we are right in the thick of earnings season. In the S&P 500, for companies in the S&P 500, they're seeing a historically strong earnings season. That is because 83% of companies, as I'm recording this, are beating on earnings. That is well above the historical average of 74%. It's also the best showing in 4 years. Now, the blended earnings growth rate year over year is running at 10.7%. If that holds up, that would mark the fourth consecutive quarter of double-digit earnings growth. But here's the thing. Not only are companies beating on the bottom line, they're beating on the top line as well. 79% of companies are beating on revenues. And that's what this chart on here shows. It shows, what percent, the green bars, what percent's beating on revenues versus missing. You can see for the S&P 500 overall, 79% are beating on revenues. It's a lot. This is very significant in my opinion because it's a lot more difficult to manipulate results on the top line with revenues than it is to manipulate the bottom line with net profits. This 79% beat, that is well above the 5-year average beat at 70%. And again, I think when you take all these things together, how earnings season is coming in is pointing to a strong economy in the absence of government data. All right, the start of November also marks a favorable seasonal stretch for the stock market over multiple time periods, no matter how you want to slice it up. November, just looking at that month, November alone is the single best month for the S&P 500 since 1950 and also over the last 10 years. The S&P just recently entered the best stretch for 3-month forward returns. At the same time, we have the 6-month stretch marking the sell in May and go away period is now officially over with the start of November. And the next 6 months does rank as the top seasonal period. So if you look at the S&P 500 using data back to 1950, which is what this table does, and it ranks out these various 6-month periods that you can see on here, the November to April period that we are just now starting has a 7.1% average return and a 77% win rate. And you can see both figures stand out as being the best of any other period shown on here. All right, another aspect of seasonality is just look at how the S&P 500 performed around Fed rate cuts. And what we're specifically interested in is how the S&P does when the Fed starts resuming again after being on pause, because that's what we have. So what this chart on here does, from this chart comes from Ned Davis, it looks at how the S&P 500 does following an easing cycle where they've paused for 6 months or more. So that's what we had. We had an easing cycle started back in late 2024. The Fed did a couple rate cuts and they've been on hold until September of this year when they started cutting again. Then you can see on here this dashed line. This shows what the S&P 500 does in the 12 months heading into the first cut after a pause and what it does after. And so this first cut after a pause, this would line up with the Fed resuming rate cuts back in September. And you can see the gold line on here is the current S&P 500. The blue line is how the S&P tends to do on average looking back when you've had that extended pause. It notes these episodes to form this blue line on here. And you can see this is another, in general, favorable catalyst for the S&P 500. The global liquidity backdrop, that should remain a tailwind for the bull market heading into next year. The global money supply, we can look at that by looking at M2, and that is recently topping historical records at over $95 trillion. So what this chart on here does is it takes global M2 and overlays the S&P 500. So M2 is this white line, the S&P 500 being the gold line on here, and you can see there's a positive correlation between what the S&P is doing and global liquidity. So we know global liquidity is a boost to financial assets. Well, it helps in more ways than one. So liquidity also helps keep financial conditions loose overall, and that's shown to be supportive of economic activity, and what's good for the economy is also good for the earnings backdrop. So this global liquidity cycle could also receive another boost from the Fed's ending of their quantitative tightening program. While the dovish aspects of the Fed's most recent meeting include another rate cut and an end to quantitative tightening, we did get those hawkish comments from Powell and also some changes to the meeting statement that has the market repricing the outlook for further rate cuts. I noted earlier how the changes in market implied odds are shifting for December, but then I would also look at the recent jump we've had in the 2-year Treasury yield. So the 2-year Treasury yield, that's the black line on here. You can see it tends to lead changes in the Fed funds rate, which is the blue line. So you have this black line. Back during the last big tightening cycle starting in early 2022, you actually had the 2-year Treasury yield rising significantly before that, so flagging the risk of an incoming tightening cycle. And then you had the 2-year Treasury yield crossing below and sustaining a move below Fed funds back in early 2023, and that flagged the easing cycle that eventually got underway. So what you want to watch is this recent bump higher in the 2-year Treasury yield. It now sits just 0.4% below the current level of Fed funds, this blue line on here. And so that's implying fewer than two quarter point rate cuts in total before this easing cycle is complete. All right, so the Fed reduced rates last week as widely expected. The Trump administration is demanding more cuts, but we're seeing deep divisions within the central bank. Well, there's one thing you want to keep an eye on, and it's how cuts could be impacting commodities and the inflation picture. So the Fed started this easing cycle in late 2024, cut the Fed funds rate by 1.5% since then. But there's this growing risk that cutting rates at a time when we see evidence that the economy is holding up fine, that could stoke inflation. And so that could especially be the case if we see a broader breakout in commodities. So the chart on here compares an equal weight commodity sector index, which is the white line, against the Fed funds rate, which is the red line on here. So you could see there was this big surge in commodity prices into the last inflation wave. So that kick-started by this, the big drop in Fed funds rate and easy monetary policy around the pandemic. Well, that sparked commodities. Commodities played a huge role in the inflation wave that peaked in mid-2022. But look at what's happening. Ever since the Fed started this most recent easing campaign, you've got commodities rallying once again. So watch for that impact on the rate outlook, or on inflation, how that could impact the rate outlook. All right, another busy week for earnings. Last week was the busiest week for earnings, but we're still going to have a high pace of reports rolling in. This week, I believe 136 of the S&P 500 are due to report. And again, all the headlines around the government shutdown and the lack of economic data. Well, guess what? This is some of your your best insights as to what is happening with the economy is going to come from these earnings releases like we had last week. So keep an eye, collectively on how companies in the S&P 500 are doing versus expectations. If we can continue to see that high year-over-year growth rate in earnings, if we see the high pace of both earnings and sales beats, but then we'll have plenty of opportunity to look at how certain end markets are holding up as well. Whether it's Palantir and how that plays in to the AI theme. We're going to have numerous semiconductor companies reporting with AMD, Advanced Micro Devices, and ARM and Qualcomm. So we'll get a look at how the consumer is doing with McDonald's. And so again, you can look through to these various companies or end markets, and then collectively how they're doing in the absence of government data, economic data. All right, one trade I want to keep an eye on this coming week is with Dave, ticker DAVE. This is a fintech stock that had a huge run last year, and it's creating a new basing pattern. So we can look and see that Dave ran up to this $275 level back in late June, early July, and started a new basing pattern. So we had this pullback, and what I'm interested in with the stock right now is we've had now a rally. After this basing period, this 4 or 5 month basing period, we've had this rally back toward the prior high, and now we're getting a smaller pullback. So that's what we want to look for, that evidence of accumulation in the basing structure with that smaller pullback. So what I want to see now, ideally this pullback retraces 50% or less of this rally off 200. We're going to look for a bullish momentum reset with the MACD at the 0 line. And then we look for a breakout over this blue line, a breakout to over that 275 level, which could then be our opportunity to add a position in this stock. All right, that's all for this week.